It's good now.
Okay, great.
Yeah, it is.
Sorry for this, everyone. Okay, so we've gone through our disclaimers. I go back to the screen what I was talking about. So we got agenda, we got super fun. So we were here. We were actually talking about the difference between self-managed super fund and the other type of super funds. So as you are aware of, like there are industry super fund, there are retail super fund, there are employer super fund, defined benefit super fund, and self-managed super fund. The main difference between the other super funds and self-managed super fund is this: in self-managed super fund, it's the members who are the trustee or the directors of the trustee company as well. They are the one who manage the super fund. Whereas in other super funds, it's the trustees of that super fund manage for all the members. So both those are more like, if you say, is a public company, whereas self-managed super fund is like a private company. I'm just trying to tell you the difference. Now, in self-managed super fund, the control is in members or trustees' hands, and as the control, the responsibilities are of members and trustees as well. So whatever you decide, it's your responsibility. Now, members and trustees, they decide where to invest, so they can choose what type of investments they want, where to invest, how to invest, when to invest. The whole decision is in the hands of members. And obviously, in self-managed super fund is the only super fund where you can invest almost everywhere. So there are a lot of investments available in compared to any industry or retail super fund. Now, where and what type of investments are available in self-managed super fund? So there are cash or term deposits. You can invest in just normal cash and term deposit. You can buy shares in Australia, outside Australia, in overseas markets. You can buy ETFs. You can actually invest in managed fund. You can buy crypto, gold, silver, platinum, any of those precious metals. You can actually invest in paintings, vintage cars, jewelry as well. And most importantly, yes, you can buy property, whether residential or commercial, in self-managed super fund. And there are many more investments. As long as you stay with the rules, you follow the SIS or self-managed super fund rules, you can invest almost in any type of investment. Now let's talk about property investment. So in this seminar, we are mainly focusing on the property investment in self-managed super fund. If you want to talk about or want to know about any other type of investments, we can discuss that separately. So out of all the super funds that I mentioned earlier, it's only self-managed super fund that allows you to invest directly into the property. You can do indirect investments in other super funds, but in self-managed super fund, you can actually go and buy the investment. You can buy any type of property. So you can buy commercial, residential, townhouse, apartment, any type of property you can buy in self-managed super fund. You can actually also invest in land only. So you can just buy the land only without the building on it. You can go for home and land package, provided that is under one contract if you are borrowing against it. So saying that you can't actually buy land and build on it if it's with the loan. So if you're using the borrowing for that one, so that's the restriction there. Now, the question how actually we can buy in self-managed super fund. You can buy directly without going for loans. So you've got, so say for example, you and your partner both got 400,000 in super, you combined your super and you can go and just buy a property outright for 700,000. So no loan, and it's simple. The second option is you can actually do additional contributions, either concessional or non-concessional. So say, for example, you're looking for 500,000 worth of property. You only got 400,000 in your super and you are short of 100,000, but you've got this 100,000 sitting outside the super environment. You can actually then put this money as a contribution in your self-managed super fund, provided you are under the limit. And now you've got 500,000. You can actually invest that in self-managed in a property. It's one way. So that money is gone into super fund as a contribution, you can't take it out. So you need to be careful when you make these type of decisions. And the third option is with the loan or borrowings, and we call it limited recourse borrowing arrangement, or short form LRBA. You may have read or heard this word a lot of times. Now, let's talk about what is limited recourse borrowing. And this is the most popular way of actually investing in self-managed super fund nowadays. So limited recourse borrowing arrangement is actually getting a loan against the property that you are buying in a self-managed super fund. Now, this is not same as buying your owner-occupied house or buying an investment property under your personal name. It is different from that one. So limited recourse borrowing, the word comes from, as it says, limited recourse. So when you're buying a property in self-managed super fund, you need to set up another trust called their trust. This is the trust who actually holds the property, and the loan is against this property. Now, why it is called limited recourse? Because if anything goes wrong with this property and or super fund is not actually capable of paying the loan, bank can only recourse this property. So if you got, say, 1 million in your super fund in shares, the bank can't come and touch those shares to actually cover up the loss. Saying that when you're actually going for any loan, you are doing the personal guarantee, so bank is covered. They can always come after you personally, but they can't touch the other assets of the super fund, and that's the reason why it's called limited recourse borrowing arrangement. The whole reason for doing that one is to actually protect your other assets. The question is this only available for properties? And the answer is no. The limited recourse borrowing arrangement can be used for any type of investments, but because it's so complex, you have to actually go through, firstly, not all investment types offer this one. And secondly, you have to go to some financial advisors to look for those products. But for the properties, it's very common. A lot of people knows about it, and it's very easy to get the loan for the property under the limited recourse borrowing arrangement. Now, the question a lot of time people ask, why to actually get a loan to buy the property in super fund? Why we just wait and just get the money in and then buy the property outright? I'll explain that one with a small example. So this is my small worksheet. Now, this is just a rough idea. I haven't taken into account a lot of things like inflation and all those. So let's take an example. So we've got a cash contribution. So we've got a cash sitting in super or with you 100,000. So we can either invest that 100,000. Now I'm taking any type of investment, whether it's a share or property, and assuming that all investments are going to grow at 10%. So we are comparing apple with apple. So if we are investing this 100,000, in year one, we're going to get a growth of around 10,471 at 10% return, cumulative growth. If we got this 100,000 and we go to the bank and we say that we're going to buy an asset of 500,000, here's my 100,000, can you give me a loan of 400,000? Bank gives you this loan, and now you got an asset of 500,000 with this 100,000 cash contribution. Your asset in year one is going to grow to 552 approximately, but obviously you're going to pay the interest and the principal. I'm taking 6% average interest rate here because usually home loans are around 10%, super fund loans are always higher. So currently actually they are around above 7%, but on average, let's say 6%. So in year one, you pay interest and principal, plus you've got outstanding balance as well. So your net growth is 28,000. So you can see it's nearly double in first year. Fast forward, look at the year 25. You've got 1.1 million growth with 100,000 of investment, but you've got now around 5.5 million growth, which is nearly 5 times with a loan and borrowing. And reason for that one is you're increasing your return, or you're getting a return on a 500,000 investment compared to 100,000. So your investment is going up and your loan is going down. And that's the reason why borrowing always or leverage always gives you the better result. So as the SMSF is the same, so if you get that loan in SMSF, you can actually make your retirement fund 5 times more compared to what it is without the loan. Now, most of the time people ask the question, okay, that's good, we can invest in the super fund. Are there any restrictions? Yes, there are. There are restrictions when you are actually buying a property in self-managed super fund. So the first one is, as I mentioned earlier, you can't buy a house and land package if it's under a separate contract. It needs to be under one contract because under the limited recourse borrowing arrangement, it needs to be a single asset. And if it's a house and land separately, it's considered as a two separate assets. You or your members or the related parties can't actually live in that residential property. When we say related parties, it's not just your relatives or your siblings. Related parties covers more than that. So your business partners, your employee-employee relationship, they are also related to you. So if you buy a property in self-managed super fund, you can't live in it. Your family members or your related people related to you can't live in it. So, and your business partners or their relatives can't. So anyone that's associated to you under the definition of related parties can't actually live in that property. Now, often, of course, people ask, what if the arrangement is through a real estate agent? We are paying the market rent. Even then, it's not allowed. So you can't actually do, and the fines and the penalties are very high if you do that. But if the property is commercial property, then actually you can rent it to your business. So that's the exception here. The most importantly, the big difference is if the property is in your self-managed super fund, you actually can't use any of the rental income or capital gains made from that property for your personal expenses before the retirement. So say if you are 50 and you sold this property, you made the profit on that one and you want to use that one to go on holidays. No, you can't do that one. You can do that if you are retired. So if you're over 67 and your fund is in pension, you can do that. But before that, you can't do. But you can actually use that fund to buy another investment in self-managed super fund. So the restriction is you can't use personally. So you can't use that money to buy personal assets, or you can't use that money to spend on your personal expenses. Now, the most big important one, the tax benefits on self-managed super fund or any super. Now, as everyone aware of, the income in self-managed super fund is actually taxed at 15%, or in any super environment is taxed at 15%. Capital gain made on any investment is at 10% if it's more than 12 months. So if we take into account the 50 discount, then actual tax comes around 10%. The best part is when actually fund is in pension phase, which means when you're retired and the fund went to the pension phase, all this income and capital gain is taxed at 0%. So there's no tax on in the retirement phase. There are some exceptions to that, but that's for the high income earners. So there are some slightly higher tax when you are earning higher or when you are above some threshold. So which goes up to 30%. But if you want to talk about that, yeah, I can explain separately. Now let's take an example to see how the tax benefit works in a super fund. So say you sold a property and made a capital gain of 500,000. Now, if this was under your personal name, you would have paid 47% marginal tax because it's a 500,000. After taking into discount, it's 117,000 tax that you're going to pay. If this property was in self-managed super fund, you would actually pay only 15% tax. After discount, it was 50,000 in tax. So compare the benefit. 67,500 is in your pocket instead of paying that to the tax office. That's the gain. Now, to make it even better, if this property was sold in retirement phase or in pension phase, then once you retire, the whole 117,000 is in your hands instead of going to the tax office. That's the difference. And you can use that 117,000 to sit on a beach like these two people in the picture. So now we know, yes, property is very good. It can give you a lot of benefits. It can give you tax benefits. Why? What's the difference between buying property in self-managed super fund versus outside self-managed super fund? So let's go with pros and cons. So if the property is in self-managed super fund, you can only pay 15% tax. You can only pay 10% tax on capital gains. So that's the big benefit of that one. You can actually sell this property and use that capital gains and invest in other assets. And same thing applies to other assets as well. Any income 15%, any capital gain 10%. Now, if it's in retirement phase, no tax to pay at all. And that's the big benefit, because you don't want to pay any tax when you are retired. So that's a big benefit if you're looking for the retirement, and if you're buying those assets for your retirement, super fund or SMSF is the way. If it's a commercial property, you can actually rent it back to your business, and you can take even further tax advantages by doing that. Now, what are the disadvantages or cons? So firstly, you can't use that rental income to live on before your retirement. So if you want to use that rental income to offset your current income, unfortunately, you can't do if it's in self-managed super fund. You actually can't refinance the property and use the equity to buy another property like we do when we buy under personal name. So self-managed super fund doesn't allow that one. That's one of the big drawbacks. You cannot, as I mentioned earlier, you cannot live in it, and you can't rent it to the related party. And the other one is you can't actually do the renovations if the property is under limited recourse borrowing. So if you plan to buy a property which is run down and you want to actually do the renovations and sell that to make a gain, you can't do that one in self-managed super fund if it's via limited recourse borrowing. If there's no loan involved, no issue, you can actually do that. It's just with the limited recourse borrowing arrangement. Now, things you should consider before actually you decide whether you want to set up a self-managed super fund or you want to buy the property in a self-managed super fund. I don't want to scare you, but it's just few extra things. Not hard, just like setting up your another company if you have or business. With self-managed super fund, there's a running cost involved, so you need to keep that one in mind. It requires some time and knowledge. And always your accountant, your financial advisor, or professional people are always there to help you with those type of things. Now, buying a property in self-managed super fund is expensive compared to buying under individual name, just because you need to set up the bare trust. Interest rates are slightly higher compared to when you're buying personally. Now, you as a trustee, you take the responsibility of everything. As I say, there are always professionals there who can help you with that one, because these all costs are minimal compared to the tax savings and other savings that you can actually have there. So, but I always recommend to actually, if you're not sure about that one, always speak to a professional or a financial advisor to know whether the self-managed super fund is a good option for you. So that's about the self-managed super fund. So, yep, if you have any questions, just put that under Q&A, and I will now hand over to Denny to actually go over his part of the presentation. Over to you, Denny. Denny?
Can you hear me now? Hello.
Hello. Yep, Denny, over to you.
Yeah, there's a bit of lag on the internet. Anyway, thank you, Bimal. It was really informative. As I said, anyone has any questions, just put it in the Q&A. If you want to come on video, I can also let you, if you request for that. Let me try to present my part. So what we understand from the SMSF, what Bimal just said is, borrowing is a good thing in a way that the value of the amount that you're borrowing will go down over the years, and the value of the asset that you're purchasing will go up as the years goes by. So she in particular showed you a slide which compared between an investment in the superannuation, where you put it in the industrial fund, and the comparison with the leverage of borrowing money from the bank and using that borrowed amount to grow your superannuation. So it was very clear that borrowing fund and growing your superannuation through that is more effective than keeping your superannuation fund and putting in the industry funds. Sorry. So why property investment? So this is what exactly we were talking. So property by itself is a very good asset. It's a more stable asset, less volatile, and it is a physical asset, which is physical nature, which you can see and feel, and it is an asset where people live in it, rather than a industrial fund or a share or other crypto. I'm not licensed to talk about other assets, but property is a very safe. If you compare property and look into the past history, property has always performed well, and the value of the property has been going up. So it is a more safer kind of investment, or a asset that you can buy through your superannuation. So when we go buy property, there are several restrictions. As Bimal mentioned, you cannot buy a land and house package. You can make it as a package where the builder or the developer can put it in one contract. Usually land and house package is you buy the land, and then a separate contract is made for the building. So that is not allowed, as Bimal mentioned. And what is the purpose of the building? You can't let it out for holidaying. You can't let it out to rent to your relatives or friends. So there are certain restrictions that we need to look into when we're buying a property. So it is always, as we buy a property in your own name, it is same way important to buy the property in a very strategically and to buy it in a good location with good cash flow and capital growth. So I, as a buyer's agent, look into that to buy a property in a very good location that can give you enough of cash flow in form of rent that can maintain the loan and the interest rate that you're going to pay, and also give you a very good capital growth in the next 10 or 20 years, whenever your age of retirement is coming. So it may be 60, 67 years. So you should have a very good capital growth by then. So it's very important to look into the location of the property. So some of the factors that we look into is how much is the budget and how many years do you have left for retirement, so that based on that we can go into the properties, go into the suburbs to find out which suburb is performing and how fast can you grow your capital within that short duration of time before your retirement. So yeah, these are some of the strategies that we follow. Is cash flow important, capital growth important, or both important at this stage? for a person who is in their 20s or 30s, cash flow shouldn't be a problem. A capital growth is what we are looking into, because they have a big number of years left before their retirement. Then we can go into more capital growth focused property buying. Yeah, so based on what we sit with the client and understand, we decide on what kind of property or what kind of strategy that we can we need to go into when we're buying the property. When and where to buy, it is always said, should I wait to buy the investment property? Should I wait for a few more years? That is a question. Should I wait for the interest rates to go down? Or should I wait when the prices are going to fall? The answer is that the best time to buy the property was yesterday, because property prices, as I mentioned previously, property prices has always been going up. There's and it is a long-term game. It's not something that you buy today and sell in the next few months. Property investment is a long-term game, and that you have to keep that in perspective and buy the property as and when it is possible for you to buy. Like now the interest rates is going up, your borrowing capacity has gone down. So if there is a interest rate rise in the next few months, then your borrowing capacity again will dropping. So if you are able to borrow money today, then today is the best time to buy a property. So don't wait for the opportunity to come. But there are important things to look into when you buy a property. We need to see whether you're not overpaying, and whether that particular suburb or the property's price is going to fall in the next few months. Then you're going to make a loss. So it's very important to understand where you're buying and do the research. So we as a buyer's agent, we look into the property cycle. So this is how a property cycle, from the peak of the property price, the prices start to decline, and then it's nearing the bottom and it reaches the bottom. So identifying where a particular suburb is sitting in property price wise is very important before we buy a property. So what usually happens is people come to know that a particular suburb is performing good, and it comes in the news media that a property price is the suburb is doing good. Probably the cycle is above the rising market or nearing the peak. So when a general public hears that, then they go to the suburb, purchase a property, and within a few months they will notice that the prices have reached the peak and there is no further growth. And then the property market corrects itself. There are instances where the property market could drop by 40%. So for the next few years, depending on the suburb, it may be 3 years, maybe 4 years, 5 years, 6 years, the property prices tend to go down and sit bottom for a long period of time. So there is no growth happening during that phase. So it is important to identify at which phase of the property cycle you're purchasing. It is better to buy at the bottom and a stage where it is just about to go up. So we identify that when we purchase property for our client. So in our agency, we have a very stringent methodology and what we follow to get the best outcome for our client. Some of the factors are capital growth, rental yield. We look into the demand and supply, how much of supply is going to come in a short period of time. What is the demand looking like? What is the population influx to that particular suburb, etc. Vacancy rate. What is the employment rate in that particular suburb? Property cycle, which I already mentioned. What is the socio-economic status of that particular suburb? Are the people going to afford if the prices goes up, or are the people already struggling with the current price? What is the rent looking like? Can it go up? Social housing, crime rates of that particular suburb is very important. It is very important factor if the property prices are going to go up or not. Owner occupied demand is a very important factor. we need to compete with the owner occupiers when you're buying a property, not go and compete with other investors that may be coming from interstate, because investors come and go. Owner occupied are the people who are living in that suburb and are going to live there for long. So if you compete with them, they are emotional buyers. So that suburb or that particular part of the suburb is where the property prices tend to go up. So where usually the demand by the owner occupied is an area that is established, area that is close to good school, good colleges, universities, good transportation, good road network, train station, bus station, etc. So that is where we have to look to buy a property. So other important checks that needs to be done is flood mapping, fire danger, other things that I've already mentioned. So the importance of buying a good property with the right strategy is, of course, get a superior capital growth, as I mentioned, looking at the property cycle and also looking into the fundamentals of a particular suburb. Why this particular suburb will grow in future is a question that needs to be asked. What is the infrastructure that is going to come? What is the employment or the industries that are going to come? What are the reasons that people would like to live in this suburb? Are important questions to ask before choosing a suburb. Rental income, of course, capital growth is very important in superannuation, but to sustain your loan so that it does not affect your lifestyle and does not bring a huge stress, it's very important to look into how much of rent you're going to get when you're investing in a particular suburb. If you have a good capital growth, you develop equity, and if you have a good income, that will help with your serviceability. When both these two factors are fulfilled, then the bank will be happy to lend you more money. And even in SMSF, you can keep purchasing properties and build your portfolio. It is true even in your personal name. You can buy investment properties if your capital growth and good rental is a good tick, so the bank will be happy to lend you more and keep building your portfolio. If you go wrong in either of this and you don't have enough of income, that's when people get stuck. You can always book a free discovery call with us. The link should be on the website, propertyzeal.com.au, or ring me and contact me. Please feel free to contact either of us, Auto SMSF, Bimal, on that number, and that's the email ID. You probably can take a photo of it on the screen, or take a screenshot if you want these contact details, or you can log into the website and get those details. So I think we'll go into the Q&A session.
Yep.
If anyone wants to come on a video, I can let you, or you can just type in your questions in the Q&A session.
Okay.
You're able to see the questions, Bimal. I think they're more relevant to you.
Yes.
There's a couple of questions.
I can see I've got 2 questions here. So I'll start with the first one. So the question is land only allowed? How to justify that wealth creation towards retirement savings when creating a trust deed? Land only does not provide an income except capital growth. So does this need to be specified in the trust deed? So the first answer to the question is land only allowed, and it is yes, you can buy the land only in your self-managed super fund. As a part of the self-managed super fund, you have to actually do an investment strategy every year and review it every year. Now, your investment strategy tells what you are investing in and why you are investing that way. So that's where you can just put the land in, the reason why you are. So if you are buying a land which actually is as per your investment strategy and is in the best interest of the members for their retirement, it is allowed. So so it's not the trustee, it's actually the investment strategy that includes why and how you are going to invest in each asset. Like as I say, you cannot even buy a classic or vintage car in a super fund, which won't give you any income. But because it's going to go up in value and the trustees actually decided that's the right decision based on their strategy, that's allowed. Okay, so if you got any question around this question, please start in. I'll move to the second question, and that is, under limited recourse borrowing arrangement, can an equity in one property be assessed and used to purchase another property within SMSF? The answer is no. So you can't actually refinance a property in a self-managed super fund and take the equity out. As I mentioned, it is limited recourse borrowing arrangement. So one property and one loan, second property, second loan. You can't refinance a loan to increase the loan under limited recourse borrowing arrangement. The only time you can refinance a loan under limited recourse borrowing arrangement is when actually it's in the benefit of the property or of the SMSF, for example, to reduce the interest rate or something. Other than that, you can't actually increase the loan under this limited recourse borrowing. Okay, the next question is around the trustees. So the question is, how much effort or time the trustee should put to manage their SMSF? What level of subject knowledge one should have to manage it? Now, it's not a time. Usually people say you're looking for few hours a month to put that one in. Now, because you are the one who's responsible for self-managed super fund, so you are the one who are actually investing. So it's the time towards that investment. So say, for example, you bought a property, you need to look after that one. You need to make sure that how you are going to spend time when the property is under your name as well. So it's a similar time around that. Other than that, you need to make sure that every income and expenses are properly done. You need to do the annual accounting, financials, audit, those type of things. So that's where the additional time goes. It's nothing that you have to do on more regular, like you don't have to really do a bookkeeping like a business, but you have to manage all the income and expenses separately. So so you can't just use your credit card and pay for super fund expenses. So that's where the extra time goes. With regards to the knowledge, there are a lot of videos on ATO website around different parts of the super fund. So if you have a generic knowledge of the super fund, how it works, and you've got the professionals around you who can actually help you, I think it's not a rocket science. You can easily learn the things. The main thing is just ask the professionals before actually doing anything. So say, for example, you've got some money to pay or you got an expense to pay. You are not sure because you don't have enough money in super fund as your super is not contributed yet. And instead of just going and paying with your credit card, maybe ask your professional what's the best way to do it. So wherever you got a question, ask the professional. And I think that's where your time really goes, and that's where you learn the things. But as I say, it's not a rocket science. As long as you are not doing the silly things, you are okay with that one. I hope I answered that question. Any other question? Yep, there's one more coming. So the question is, I think they're asking for the super fund again. So the question is a commercial property, if a commercial property is bought and rented to own business, can that office space be also sublet to other tenants? The answer is yes. So with the commercial one, it's exactly like, think of your landlord. So your super fund is your landlord. And if your lease actually allows to sublet that to someone else, you can do the same. So so me as a super fund is actually letting you as a tenant, and my lease includes the sublet in that one. So that's fine. You can do that one. So this is the beauty of like a lot of business people actually buy commercial property in super fund just for that purpose. Any other questions?
More questions, anyone?
Okay,
Or
one point. Yep. Okay, let's get this one. Okay. Can a residential property bought and rented to your business to run a business from that property? Tricky. Actually, the answer is no. If the property is residential, you can't, because there are specific rules around whether the property is commercial or residential based on different things. So if the property is residential, it's not considered. Like, so you can't say I rent it. For example, I'm an accountant and I rent my property to me because I can sit in a room and work that way. Oh, answer is no. So it needs to be a commercial property. I think I answered that question. That no, even if it's a house, so if it falls under the commercial property, because some properties I know are commercial and residential when it's zoned that way. But if it falls under the commercial property with the zoning, with the SRO, with the other authorities, then it's fine. But if it's a pure residential property and it's input tax as well, it's we can't rent it out to the third party.
So Dipin, you want to come on a video? Yeah. One second, let me try. I think you should be able to get on, Dipin. Yeah, you're on, Dipin. You can start asking.
Oh, sorry, guys. Thank you. Hello, guys. Thank you so much for the webinar. So what I'm trying to ask was, so where I live in the area, there are some houses, right? There has been, I mean, the outside is still a residential property, but inside they have actually renovated to do medical centers, and they run the business of a medical center from there. So if we buy that sort of property through our SMSF, is that allowed to do that then?
So my question is that property actually commercial property with the council, because I know some properties are like, for example, they are zoned one property, so that you can actually run a business from there. So how the land tax treat that property, how the council treat that property, and if they treat that commercial / residential, then yes, answer is yes, you can buy it. But if that property falls under residential for those ones, then the answer is no. But I can look into that one in more detail for you. So that's what my understanding is. But again, it also depends on state by state as well, because the properties with commercial versus residential are very much state based.
Yep.
So, but I can look into that one. But as a simple is like, you look at what the other authorities looked at property as. So if it's a commercial, then answer is yes. If it's a residential, then answer is no. Because you can't actually run, for example, medical practice from any house. There are only few properties allowed for that one.
Yeah. So,
Yeah.
look, I understand what you meant, Denny, is because I feel, and this is just my guess, to be honest, that those properties have been classified by the council as commercial, obviously, because I mean, if you want to run a medical center, you probably need that approval from the council to be able to run that sort of business there.
Yeah, that's right. Yes,
but
because otherwise the neighbors will
outside,
oppose.
the house.
Yeah. So, and now exactly. So because I know when the properties are actually zoned and they go into the zone 1 from zone 2 or 3, then actually they are, even though it's a house, they are considered as a commercial property. So in some places, yes. So it's
makes sense.
but it's a good question. So, and especially when it's happening more often nowadays. So I will actually check on that one, and I'll let you know. Yep.
Okay, all right, all good. Well, thank you. Thanks for letting me in. Thanks, Denny.
No worries. Thanks. Anyone got any other question?
I think
No. Yep. I think that's Yep. So you guys got our contact. Yeah. So if you got any questions, please feel free to send us an email or give us a call.
Thank you, everyone. Thanks for attending. I hope you have a lovely evening. Thanks, Bimal, for coming and presenting. It was very informative. As Bimal just said, if you have any questions, email it to us or or just call us if you're interested to go ahead. All right. Good evening and good night. Bye-bye, everyone. See you.
Yeah. Thanks, Denny. Thanks, everyone, for attending. Bye. Good night.